Welcome to the Short Term Show, the show about short-term rentals and long-term wealth, with real property owners hosting real properties who are crushing it in the vacation and short-term rental space. And here's your host, Avery Carl.
Good morning out there, all you short-term shoppers. It's Avery Carl, and I wanted to give you guys a quick reminder about something that I don't think I've done a good enough job of keeping you aware of. So I get a lot of emails from y'all every week, and I love getting emails from you, by the way. I love talking to our listeners, and a lot of them are asking for real estate agent recommendations in different markets. And what I don't think I've done a good job of is making sure that you guys are aware that the Short Term Show is actually a subsidiary of the Short Term Shop, which is the largest short-term rental specific real estate team brokered by EXP. I have to say that or I get in trouble in the country. So we have offices in 12 of the top short-term rental markets in the country, and we are here to help you purchase your first, second, third, or 10th short-term rental. And if you buy with us in any of those markets, we have a whole back-end training program where we will teach you everything you need to know about managing your short-term rental remotely. Everything from setting up your Airbnb and VRBO listings to teaching you how to use all the property management software that you'll need, all the way down to helping you source your local boots on the ground like cleaners and handymen. And we have some awesome Facebook support communities that we want you guys to be a part of, where we all share ideas and information about managing our short-term rental, which short-term rentals, which markets are the best, what we're doing next, and all of that really fun stuff. So if you want to be a part of the Short-Term Shop community, if you want to buy a house with us, we really want to help you guys. So head on over to theshorttermshop.com and click schedule a consultation. We'll see you there. Welcome back, short-term shoppers. Today we have Kent Ritter, the CEO of Hudson Investing. Kent is a former management consultant, corporate executive, and has a number of startups that he has exited to form Hudson Investing. So Kent, tell us a little bit about yourself. Tell us who you are, what you do, and what you're working on now.
Yeah, I'd love to. So born and raised in the Midwest in Indianapolis. And when I got out of school, I always had known I always had kind of had the entrepreneurial spirit, always knew I wanted to own my own business. I didn't know exactly what I wanted to own yet, and didn't really find that until much later, but I always just had that in mind. And so as I was coming out of school, thought that management consulting would be a great way to see a lot of different businesses and understand what works and what doesn't, and just get a really good understanding of how to run a business for when I found the right one for me. And so I did that for 12 years after graduating, lived in Chicago, and flew all over the country helping businesses solve problems that they couldn't solve themselves. And so in those 12 years, saw hundreds, if not 1,000 different businesses, and got to see what works and what doesn't. And it was a really good education on just how to run your own. And so in 2010, some partners and I left the firm that we were at, and we decided to start our own firm because we really saw a shift in the market. We didn't feel that the firm that we were at was going to be able to pivot and make that shift. And so we decided to go and start our own and really focus on in a particular area. And for a little bit of luck and for making the right choice and taking the risk, we were rewarded. And that business grew from 5 guys around a kitchen table to 95 employees and 30 million in annual revenue in about 5.5 years. And then we exited that at the end of 2015. And that's really when my real estate career got started in earnest. And so we had the capital from selling that business and decided to start to diversify, right? I didn't want to have all my eggs in one basket. I had a stock market portfolio, but I had not invested in real estate. So I started doing a bunch of research, and like I think a lot of people do, you find the people around you that that are in real estate. And I started implementing some of the strategies that they were doing. For example, buying a note portfolio or creating a note portfolio and holding houses on contract. Started doing some fix and flips, started buying some singles and duplexes, and built up a small portfolio of about, I think we had about 11 of those at the peak. And at that same time, I started investing with others in larger multifamily. So I really learned about this syndication process, and what that really means is just, it's a fancy name for saying folks are pooling their money together to invest in something bigger and better than they could on their own. And so I realized I could actually invest with experts, with other people in these deals. And I was investing in larger multifamily deals in that way. So I kind of was doing a whole bunch of different things to try to find my groove back then and figure out what would really work for me.
Awesome. So let's start at the beginning. Once you exited your company and you have all this capital to do something with, what made you land on real estate?
Yeah, real estate for a number of reasons. So, I wasn't looking saying, okay, I have to get into real estate. I really started looking at, okay, what are alternative investments outside of the stock market where I could start to diversify? Because that's what I was looking for first and foremost, was diversification. And knowing that I wanted diversification, I needed something that wasn't correlated with the stock market. Correlated meaning, if the stock market moves up, that moves up. If it moves down, that moves down, right? So if the stock market drops, that drops too. I wanted something that wasn't related. And so real estate checked that box. So like, okay, well, there's one. Real estate, as I learned, provides excellent cash flow. So it actually provides cash flow. You're not just waiting there for something to happen, 5-10 years down the road and be paid out. It provides, much better cash flow than like most dividend stocks, for example. Real estate has the appreciation component because, real estate, historically has appreciated and gone up. And then real estate has tax savings because real estate's one of the only assets where, even though the asset's actually increasing in value, you get to depreciate it and you get to take those losses and use those to save on taxes. And so it really was checking all these boxes. And I was realizing, you put all these together, what kind of value that can create. And really the light bulb went off and said, wow, I got to start investing in real estate. And so then I set out to find different ways to do that, right? Because there's a lot of ways that you can invest in real estate.
So tell us what your very first deal was. So you landed on real estate. It checks all these boxes. So you've decided, okay, I'm going to do this. What was your first deal?
So my first deal would have been buying, basically creating a note on a house. So essentially buying a house and then selling it on contract to someone else and holding the note on that house. So holding the loan. That was the first deal that I did. And I think I was getting like 8 or 9%, an 8 or 9% interest rate.
Okay. So let's talk to me like I'm 3 here. So you bought the house, you sold it to someone else, but owner financed it to them. So you're getting that mortgage payment every month. Okay.
Exactly.
Gotcha. Okay. And how many of those did you do? Because you said you got into some fix and flips too. So when did that come about?
About that same time. And so I bought 4 houses and sold them on contract. And that was enough for me. What I found out was, it's nice being the bank. That was kind of the sell was, oh, you don't have to worry about, the actual performance of the asset. You're the bank, worst thing happens, then you can just, take over the property. Right. And then you end up with the property if they default. Well, what I found in reality was it was just as hard to collect those principal and interest payments as it was to collect rent. And it was really eye-opening for me. About 2 years in, one of the people that I had sold the house to, they then turned around and sold the house. And I got the HUD statement because I was getting my loan paid back, and said, wow, it's great, I'm getting my loan paid back. That worked. I got my interest for that period of time, but the house doubled in value. And so the guy is doubling his money and I'm getting my loan paid back. I'm like, okay, well, I've got higher risk tolerance than just this debt. So I better start buying assets because I want my money to double as well. And so I started looking at, okay, we need to buy assets. And so that's when really fix and flip started. And I had a friend who had been flipping houses for about 10 years and was experienced. And so I said, hey, if I fund you, let's grow this, let's scale this business. And we did. And like I said, we purchased about 11 houses, all in kind of a lower dollar. We were buying stuff for like 12 to 40,000 and putting a significant amount into them and then either flipping them or turning them into rentals. And so, and that worked well too. But the problem was it's just not scalable. We just really hit a brick wall on how big we could grow. And you start realizing, what it takes to buy a house versus what it takes to buy an apartment building. And in many ways, buying an apartment building is easier, and you can buy 100 doors at a time versus one door. And a lot of the tasks you have to do are the same. And so that's where I really saw multifamily as a way to, really start scaling and really start to build out a sizable portfolio.
That's really interesting. And I hear a lot about note investing. I've never gone down that path myself, but that's a snag that I've never thought about, is that if you're being the bank, you're missing out on the equity of actually owning the appreciating asset. So that's an interesting point that I have not heard made before. All right, so let's talk about scaling. So I totally agree with you. I went from buying single families, whether they were short terms or long terms, like we have a mix of both. But at a certain point, we were like, okay, we can buy 10 more of these single families and rehab them and do all that, or we can buy 10 of them at one time in one building. And that's a little bit easier. So especially once you get to the point of being able to obtain commercial financing, like if you have a relationship with a local bank who wants to fund your deals, it actually is easier to get an apartment building. Whereas at the beginning of an investment career, when you may not have the experience to show a bank, or you may not have a great personal financial statement or PFS to show them, it can be easier to get just a single family home, which is kind of how I landed on starting with short-term rentals, is that it's really easy to go get conventional financing on a short-term rental. Then once you have a certain number of those and you have X amount of cash flow, then it does make sense to jump over into that commercial space and with the apartment building. So tell me about your first multifamily deal, now that we're jumping into that side of things.
Sure. So, I started in multifamily, really, like I said, investing passively with other people. And so, my first multifamily deals, my first probably 12 deals, I think it is, were all passive investments, right? So investing with sponsors, with experts who were doing this, were putting the deals together. And so those deals were, kind of all over the country. So, Southeast and the Midwest, Texas, really looking for some geographic diversification, right? And then just building relationships with sponsors. I'd say the very first one I did was actually through a crowdfunding site. And, that one, I did 2 investments through a crowdfunding site. One went fine. The other one did not go well. The second one, we actually lost our money on, and actually still have some outstanding trying to recoup, because the sponsor was just a bad guy. And we didn't know that at the time. And so that was a big lesson learned for me, because it taught me that all I was looking at the time was the deal, and saying, yeah, it seems like a good deal. It's in a good market, like good location. The metrics make sense, but I wasn't spending any time vetting the sponsor, like the person who was actually running the deal. Right. And, the long story short is the guy ended up committing fraud, and all the investors lost our money, and we're still trying to claw some of that back. And that was 2015 at this point. And so that was not fun, but you chalk everything up to a learning experience. And it wasn't real estate's fault. It didn't turn me off to real estate. It just made me smarter about what I should be looking for when I look to invest with somebody.
Okay, I want to dive into this a little bit, because there are lots and lots of syndications out there, lots of different routes to take. So when you're looking at these things, so I've only invested in one syndication. And for me, it was more of a networking thing than a passive income thing. So the guys running it, the GPs running it, own a lot of individual outside of their syndication, but own a lot of multifamilies in a market that I am buying multifamilies in. So as a way to kind of like get my foot in the door with them, my husband and I, both of us, and to say, hey, we're serious. If you ever want to sell any of your personal ones, I almost called them single families, any of your non-syndication deals, like, we're serious.
Mm-hmm.
Here's some money for your syndication on this bigger deal that you're doing. Hit us up whenever you need to unload some of these smaller ones to roll it into your syndication. And it worked. So we've gotten 2 off-market deals from those guys. So it's a really great way to network.
Great.
That's off topic. I want to hear about what went wrong
as much as you can say. I'm sure there's non-disclosures and things like that at play, but I want to hear what went wrong and what you would have done differently in terms of how a new investor should vet when they're looking into a syndication, how they should vet, the people that are running it.
Yeah, that's a good question. So what went wrong? I mean, essentially, when you go out and get a loan from, really anybody, but especially an agency like Fannie or Freddie, um, you can't then go out and get other loans and collateralize them all with the same property. And so that's a no-no. And so when you do that, you get in trouble. And this person got in trouble and ended up tripping his loan covenants and losing the property. And so I think more important than what happened is kind of, what's the lesson learned? The lesson learned for me is I've kind of boiled this down into a formula. And, I look for, you've got to look at it like this. When you're looking at a deal and you're looking to invest with somebody else, it really does start with the sponsor, because a good sponsor can save a bad deal and a bad sponsor can kill a good deal, per my experience. Right. And the sponsor is the person that's really making those decisions. Right. And so they're the ones that are really driving the business plan and the most important person to making sure that you're actually going to get the returns that they've put on that spreadsheet. And so I think you have to look for four things. I think first and foremost, it's integrity, which is probably the hardest thing to nail down. But I think you at least need to have a conversation with the person and make sure that you get that, you get a positive gut feeling and that kind of jive with what they're saying. I think you can, and then I think other ways you can look at that is just through track record, right? So integrity, is it a person with integrity? Is it someone that you jive with? Is it someone that in your gut you feel like is going to act in the right way, even when there's no eyes on them, right? And I think that's most important. Second is a track record. So do they have a track record of success? And I know that everybody has to get started. Like I had to get started in real estate too. At a certain point, I had no real estate track record, but I think it's important to have some sort of history of success. Maybe it's business, maybe it's in some related field, something that you can communicate how your success in that field is going to translate into real estate. Right. So I think track record is important. Then as you build up a portfolio, it's important to be able to just show wins. Right. So I think track record, I think they've got to have skin in the game. So like one of my criteria for investing with somebody else is I won't invest in a deal unless they're putting money in the deal themselves. And I expect the same for my investors too. So I invest in each of my own deals. Like I wouldn't invest in something if somebody came to me and said, "Hey, this is a great idea. I'm not putting any money in, but like you totally should put money into this deal." It would sound fishy to me. And so they got to have that. They got to have skin in the game. And then I think they've got to have a certain financial means, because at the end of the day, it's the sponsor's job, I believe, to prop up the deal in times where the deal's not doing well, to get the investors through and make sure that the investors are still made whole in the end. And if you're kind of just moving from deal to deal, like paycheck to paycheck, if the sponsor goes bankrupt or one deal over here goes bad, like what is that? It can cause a domino effect to all the deals that they have in play. And so I think it's really important that they have just, a certain amount of financial means to be able to cover things that may not be expected. And so that's like those four things are really what I look for when I'm evaluating a deal and a sponsor. And then only once the sponsor is somebody that you want to work with and checks those boxes, should you spend any time looking at the market and the deal, and it's market and deal in those levels, because you can't, you can buy the best deal in the worst neighborhood, and that's going to be a terrible deal. And so you got to make sure it's in a good market. It's a place people want to be. And only then do you actually start to dig into the deal and make sure like that's the right building to buy.
That makes a lot of sense. So I have one more question on investing with other sponsors before we get into your specifics. So
sure.
So you vetted a sponsor. You're like, okay, I like this person. I like what they're doing. Mm-hmm. When you're looking at the deal, how do you vet that?
Gotcha. Well, it really comes with, I think you really have to look into their assumptions, right? Because you can make a spreadsheet say whatever you want it to say, right? Like I could tell you every deal I do, I'm going to get you a a 30% return, right? Or a 50% return. But like, what are my assumptions? What has to happen for that to actually occur, right? And so I think it's important for investors to really understand and then challenge assumptions. And I think some of the biggest drivers of value are going to be what is the cap rate? Like, what cap rate are they going in at? More importantly, what cap rate are they planning to sell at? And is that realistic? Like, if you see a deal where, like, what I do and what a lot of good sponsors do is we're expecting to sell at a higher cap rate than how we went in. And because you're just building conservatism and you're building that cap rate expansion into your model. And so I think if people are if not doing that, just saying, well, whatever the cap rate is today, we're going to sell at that same cap rate in the future. Well, then if the cap rate moves up on you, which the easiest way to think about it is as the cap rate goes up, the value of property goes down, then you're already not going to achieve those expectations. So I think you got to look for people that are going to under promise and over deliver by building these conservative assumptions in. I think you look at cap rate. I think you look at growth assumptions. So what are the rent and other income and expense growth assumptions, right? And again, are those realistic in that market? Is it what's happening? Are they assuming, because like rents have been going crazy for the past year, right? And so I'll just use Indianapolis because that's where I live. Indianapolis has historically been a very steady kind of 3% rent growth market. Well, Indianapolis rents grew, depending on what you look at, 10 to 12% last year. And they're on pace to do the same or even more this year. But if I'm looking at somebody's underwriting and they're projecting that's going to continue for the foreseeable future, for the next 3 to 5 years, I'd say that's probably unlikely. Right? It's probably unlikely. At a certain point, there's going to be a reversion back to the mean, right? Back to the averages. And so when I'm underwriting deals, we're maybe growing rent at 5% when rents are growing at 10%. But again, I'd rather have that. I'd rather just overperform, right? If the deal looks good where we're at, then I'd rather have that all just be gravy on top. So I think you have to look at assumptions and how realistic they are. And then I think you need to look at the debt, because a lot of people focus a ton on the equity, right? And what are my equity returns going to be? And what's my upside? I think really smart investors focus more on the downside. And I think one of the number one way that you lose your money on a deal would be to default on the loan. I mean, that's really one of the only ways where you can get the deal taken away and lose your money. And so you got to look at what kind of loan are they doing? Is it variable or fixed rate? What are their assumptions? How long is the term, right? Are they assuming that they're refinancing in a certain year? Like when we do our underwriting, we don't assume a refinance. We will underwrite it and say, here's what it looks like if we just held it the whole time. Because if we refinance, inevitably the numbers are always going to look better. And so, but what if we get there in year 3 and for whatever reason, market conditions, we can't refinance or interest rates are through the roof, right? So I don't like to see refinance baked in. And I like to see that the debt assumptions, the loan to value, right? How much leverage you're taking, what's their debt coverage? Like debt coverage means how much is their income above their debt payment. So again, it's like the more narrow that is, the less income can drop before you can't pay your mortgage anymore. And so those are things that I would really look for. I mean, I honestly have a list that I've created over time of like 35 items, but those are some of the top ones.
Awesome. That's really good information, by the way, because we don't do a lot of episodes on this type of investing. So I think for people who are interested in making the jump from short term to getting into larger multifamily, this is really good info. So we've talked about how you got started and then investing with other people. So let's talk about Hudson Investing a little bit. What do you guys do at Hudson Investing?
Yeah. So at Hudson Investing, we focus on acquiring underperforming properties in outperforming markets throughout the Midwest. So I'm based in Indianapolis and we have properties in Indiana, Ohio, and Kentucky currently. And we kind of look throughout those states, and then Tennessee, Northern Alabama, and Northern Georgia as well. And so what we're looking for are markets with growth, and we're looking for properties that are undervalued. And so it's very much a kind of a very vanilla value add strategy Value add, meaning that we are buying properties that are already cash flowing, right? They're not distressed. So if you have distressed over here and you have turnkey over here, distressed meaning the properties aren't making money. You have to pump cash into them until you can get them to a point where they can make money. And that's a higher risk for reward, right? Like it's more risk, but there could be a higher reward. It's just less likely. Turnkey over here is low risk, lower reward, right? Because there's nothing, you can't really force appreciation. You can't really improve the property. You're just kind of taking organic rent growth and hoping that continues. Well, value add kind of sits right in the middle. I think it's a marriage of both, where I think to me, it's the best blend of risk and reward. Value add, meaning the property is cash flowing. The property is stable from an occupancy standpoint. We just see deficiencies that we can solve to help it make more money. Oftentimes it's because, maybe it's a mom and pop style management, right? Like we've bought several properties from long-term owners who it's their only property, and they just don't have the most sophisticated management, and they don't mark their rents to market and push their rents. And they're just not realizing all that they can out of the property. And so that's a clear deficiency we can solve. We can come in better manage it, renovate units. And we know that we can create value. We can increase the net operating income, which in turn, the thing I love about commercial properties is every dollar you're increasing that NOI in the market now, you're increasing the value of the property for anywhere from $20 to $25 typically. So you can force appreciation of the property. You're not just relying on the market around you to increase like you do on some of the smaller residential.
Yeah, that's pretty much like kind of how not how syndication works, because there's a lot more to it than that. But I see a lot of people who want to come in and syndicate, buy a bunch of single family short-term rentals and have a big fund to do that. And to me, I'm like, I don't know if that works the way you're thinking it's going to work, because they're still appraised as residential assets. So it doesn't matter if the property is a primary home and makes $0, or if it's a short-term rental and makes $100,000 a year, it's still worth what the residential comps are. Whereas in multifamily, you can force that appreciation because the value is more based on what the property makes. So that's something that I hear a lot about. And a lot of people say, well, why aren't you syndicating short terms? And I'm like, well, because it doesn't really make sense.
Yeah, I think it's, it's gotta be just more of from a cash flow standpoint, right? I mean, that's the thing that you can control. You can't control the value as much on those singles. So yeah, I mean, I think it's a great point. But I think that's one of the benefits of why multifamily, and why it was one of the main drivers of why I moved to multifamily and really kind of fell in love with it, was just the ability to control your own destiny, if you will, being able to just make changes, increase the income, better management. Oftentimes the properties we buy were built in the 80s and 90s, and they're getting older now. And we don't buy a lot of properties earlier than the 80s, just because to me they're getting too old. Every once in a while we do. It's got to be kind of a diamond in the rough. But we buy a lot of these properties, and the owners just didn't have enough capital to really keep up with them. So what we're able to do through a syndication is bring an infusion of capital, really improve the property, and make, a massive change, do a facelift on the entire property in a matter of 12 months. And you turn around, it's a totally new property. And so I think that's one of the values of being able to infuse that capital. And that's how we create a ton of value in these properties.
Awesome. So let's talk about, if I'm an investor, again, talk to me like I've never done it before, like I don't know anything about it. If I'm an investor and I'm listening to this show and I'm like, I like this Kent guy, I like the way he's running his business, I want to go invest with Hudson Investing. What qualifications do I need to have as an investor to be able to get into one of your deals?
That's a really good question. And it depends on the type of deal that we're doing. And to try to break this down as simply as possible, these type of syndications are governed by the SEC. And so there are guidelines, because at the end of the day, we are creating a security. What you're really buying are shares in an LLC. And the only thing that LLC does is own an asset. So, but that's what you're actually buying, are shares in an LLC. And that's how you get your percentage of the property. Right. So they are governed by the SEC. And so we have a lot of guidelines that we need to follow. And and there's many different types of deals you can do. The two that most syndicators use are what we'll call a 506B deal and a 506C deal. And those are just like you hear, the term like a 1031 or a 401k or whatever. Those are all referenced from like the IRS guideline numbers. Same thing with a 506B or 506C. What a 506B deal means, which we do some of, are that really it's meant for friends and family. So the important thing of a 506B deal is there's not a requirement to be an accredited investor. So an accredited investor is something that's important to understand. It means that you have either, if you're single and file and don't file jointly, you have to make for the past 2 years over 200,000 in income and have that and be projecting that for the foreseeable future. If you're filing jointly, it's 300,000 again, past 2 years or for the foreseeable future, or you have to have at least $1 million in net worth, not including your primary residence. And so I think that usually trips people up. You got to make sure not including your house. And so if you can meet either income or net worth requirements, you are an accredited investor. And if you are an accredited investor, then you have more of these types of deals open to you. But so remember what an accredited investor is. Think about 506B. You don't have to be an accredited investor. I'm able to bring in up to 35 non-accredited investors into a 506B deal. But the important thing is we have to have a substantive pre-existing relationship. And that's why it's really more of like a friends and family deal, because you have to know these people and have a substantive relationship before you ask them for money, essentially. And so I couldn't just, Avery, like we just met today, I could not say, hey, I've got this deal. It's a 506B deal. Love for you to invest in it, right? That would not be right by the guidelines and not something that we would ever do. So the important thing there is to build, if you're not accredited, is to build relationships with sponsors ahead of time and have conversations with them. I mean, there's no hard and fast rule for a substantive relationship, but what a lot of people in the industry use is to have kind of 3 touch points over a 30-day period before, to build up a relationship, understand goals, different things before you would ever present them with a deal and with an investment opportunity. And so that's a 506B, right? A 506C deal is for accredited investors only, but you're able to what's called generally solicit the deal, meaning I can post a Facebook ad and say, hey, I've got a deal to invest in. Here's what the returns are going to look like. Who wants to invest? And so you really open yourself up to a broader market of people, but everyone has to be accredited. So really it depends on what type of deal structure it is and what type of deal is open to folks, whether they're accredited or not, are the type of deals that you can do. So we do a mixture of both. We started out like many others doing more 506B deals because I was raising money from friends and family and past coworkers and folks that I knew. And then as we've grown, we've started doing more 506C deals because my network has expanded and we've added more accredited investors. And I have people that are referring friends, other accredited investors or accredited investor groups that are coming in together. And so it just depends on the type of deal and what's right for that deal. I know I kind of went on a long tangent there, so let me know if I didn't answer the root of your question.
No, totally. So that did raise a question for me. So 506C, you can publicly market to all accredited investors, or if they're accredited, great, they can invest. 506B, do you think that since it's something you have to have a pre-existing relationship with people for, do you think that that's how a lot of these guru courses and boot camps, et cetera, came about from that are being run by these major syndicators so that they can establish that relationship with investors that aren't necessarily accredited yet, but this way they're able to broaden that pool of people that they're allowed to have invest as people that they know?
I mean, I would imagine that's probably part of the strategy in doing that. I think besides the fact that they make a ton of fees off of training, And yeah, you really, and I think it provides them with opportunities to partner with folks on deal. You know, I know a lot of those guys will partner with their students, and so it creates tremendous deal flow, an opportunity for them to get into deals that they may not have known about. So I think there's a lot of benefits in doing that. But yeah, I mean, it makes sense. I never thought about it that way, but I think to your point, yeah, I mean, it's a way to create a substantive relationship.
I just thought about that because there's a few people that I've known over the course of the years outside of my investment career that when they found out that we were into real estate investing, then they started really trying to like, oh, you should come. I'm working with so-and-so and we have this big weekend next weekend. You should come down and network. And then, oh, by the way, it's $50,000. And we're like,
Yeah.
no, thanks. But it kind of struck me when you were talking about that of course they're making a ton of money just on the fees, but it also opens up a lot of opportunity.
Yeah, absolutely. No, I think you're right.
Yeah. So last 3 questions of the show. Thank you very much for coming, by the way. We ask everyone these questions. The
Sure.
first one is, what advice do you have for 20-year-old Kent?
That's a good one. Quit messing around with management consulting, buy a duplex and start house hacking and just work your way up. That's what I tell everybody that comes to I host a meetup in Indianapolis, and a monthly meetup, and we have a lot of new or aspiring investors that come. And when I first started the meetup a couple of years ago and people would ask me, you know, how do I get started? I would kind of just, there's so many ways, right? And I would and I've done a lot of them. So I kind of throw this at them and just kind of see their eyes glaze over and their hair shoot back. Right. And so I really narrowed it down to like, okay, well, what's like really the one thing I would do? And it's absolutely house hack.
Yeah. That is the easiest and like most cost-effective way to get started, I think.
100%. You learn how to manage and you get somebody to pay your mortgage. And I mean, there's just so many benefits. And I think, and like, if you live there for 2 years, at least in Indiana, you live there for 2 years, you don't have to pay capital gains on the sale. And so if you do that every 2 years and move, you know, but if you're 20, by the time you're 30, now you've got 5 properties. And I bet you got a really solid base of income to then go and kind of catapult off of. Right. And so I think that's a great strategy.
Absolutely. And so this question, we might have already answered it. What advice do you have for a new investor getting started today besides house hacking?
Besides house hacking.
What's number 2?
I would just start networking. Like, real estate is all about relationships. It's all about your network. If you're going to be successful, you got to get out of your comfort zone and you got to get in front of people. You know, find your local meetups that are going on. Maybe there's RIA meetings going on. It depends what you want to do, right? What your strategy is, but like, find people in your market that are doing that and start networking with them. I think just being an entrepreneur in general, you'll be in the minority of most people, and most people will tell you you're crazy. If you're trying to leave a full-time job to go and be a real estate entrepreneur, most people tell you you're crazy. So I think it's important to surround yourself with like-minded people that can support you, and you can get some positive feedback versus, you know, sitting around the Thanksgiving table and everybody telling you you're nuts for what
Right.
you're doing.
Totally agree with that. And last question, what is your favorite book that has impacted your mindset?
That's a really good question. I think the book that there's 2 books that have had the biggest impact on my mindset. One would be Think and Grow Rich by Napoleon Hill, which is kind of the, you know, oldie but goodie classic on mindset. The other is Awaken the Giant by Tony Robbins. And that one I think is great because it's a lot of practical things to do to really improve your mindset, from, you know, goal setting and how to go about that. And kind of just it's a foundation for a lot of the things he teaches, you know, on how to create and maintain a good mindset. And so I think both of those books are really powerful.
Awesome. Well, that is it for the interview on the Short Term Show. Thank you so much for coming. And if our listeners want to get a hold of you, want to learn more about you, where can they find you?
Yeah, if they want to get a hold of me, they can find me at kentritter.com. And that's my home base. They can also reach out to me on social. I also have a podcast that's called Ritter on Real Estate, where we focus on more multifamily and larger commercial things, but very similar style. And yeah, I mean, and then outside of that, I think that's probably it. Those are probably the best places to track me down.
Yeah, I think that's enough ways for people to find you. Well, Kent, thanks again so much for coming on, and we will catch you later.
All right. Thanks so much for having me on.